cryptocurrencies, okay, the word itself brings up a lot, right? Fascination, maybe. Maybe a bit of confusion, too.
Definitely. A lot of people are curious, want to understand it, but it feels so complex.
Exactly. You want the gist without, needing a degree in advanced math. We all know Bitcoin, the OG, the one that started it all.
But now there's this whole universe of altcoins that sprung up afterward.
Right. And that's the core question for so many people, isn't it? Bitcoin or these other coins, what's really different? And crucially, what are the risks? What are the potential rewards?
Yeah, navigating that choice is tough.
Well, that's what we're diving into today. We've got some great material here, a risk analysis comparing Bitcoin and altcoins directly for investors, a really clear introduction to both, and then this really comprehensive global report from PwC on how regulations are shaping up in 2025.
So the goal is to get clear on those key differences.
Precisely. We want to unpack what makes Bitcoin distinct from altcoins, focusing hard on that risk perspective, and, importantly, how the rules are changing everywhere.
And, when you start with Bitcoin, its sheer impact is undeniable. Roger Ver's quote comes to mind. He said, "Bitcoin is the most important invention in the history of the world since the internet."
Wow, that's a big statement.
It is. But it captures that sense of potential disruption. The internet changed information. Bitcoin aimed to change value exchange.
Okay, let's break that down. A key feature of Bitcoin decentralization.
Right. Unlike, say, the dollar or the euro managed by central banks or governments, Bitcoin is managed by its users all over the world. No single entity is in control.
No central point of failure.
Exactly.
No.
And that's made possible by the blockchain technology underpinning it.
Ah, the blockchain. Okay, so this is like a giant shared spreadsheet.
Sort of, yeah. Imagine a digital ledger copied across thousands of computers globally. Every single Bitcoin transaction ever made is recorded on it.
Okay, so everyone has a copy and they all match up.
Precisely. Which makes it incredibly difficult to cheat or tamper with. And then there's the cryptography layer.
The codes and keys.
Yeah, public and private keys, digital signatures.
Yeah.
It's all about ensuring that transactions are authentic, that they come from who they say they come from, and that they haven't been altered.
Like a high-tech, verifiable digital seal.
You got it. And once a transaction is confirmed and added to a block on this chain, it's basically set in stone.
Immutable. You can't just go back and delete it or change it later.
That immutability builds a massive amount of trust into the system, even without a central intermediary.
So how do these transactions actually get confirmed and added? That's the mining part, right? The proof of work.
Correct. Mining serves two main purposes. It confirms transactions are valid, and it's how new Bitcoins are gradually introduced into the system.
Okay, walk us through it. What do miners actually do?
Well, they gather up recent, unconfirmed transactions, bundle them into a block. They also include a reference, like a digital fingerprint or hash, of the previous block in the chain.
Linking them together.
Exactly. But here's the crucial part. To get their block accepted onto the main chain, they have to solve a really difficult mathematical puzzle. That's the proof of work.
So they're basically racing to find a specific number using tons of computing power.
Essentially, yes. They're trying to find a hash for their new block that meets certain criteria, like having a specific number of leading zeros. It requires immense trial and error computation.
Which costs a lot in terms of electricity and hardware.
That's the point. It's deliberately costly and time-consuming. It proves they've expended real-world resources work to validate the block. It secures the network because attacking it would be prohibitively expensive.
And you mentioned the system keeps a steady pace.
Yeah, there's a difficulty metric. The network automatically adjusts how hard this puzzle is, aiming to have a new block added roughly every 10 minutes, regardless of how many miners are participating.
Fascinating. And the payoff for the miners, why do they do all this work?
They get rewarded in two ways. They collect the transaction fees attached to the transactions in their block. And more significantly, they receive a set amount of newly created Bitcoin. This is the block reward.
Ah, so that's their incentive, keeps the whole system going.
Precisely. And all these elements together, the decentralization, the secure cryptography, the proof of work mechanism, lead to Bitcoin's main advantages.
Right, so summarizing those, no central control.
Yep, high security built in.
You don't need to share loads of personal data for basic transactions, which offers some privacy.
True, though transactions are pseudonymous, not fully anonymous, the ledger itself is public.
Ah, right, transparency of the ledger itself. And potentially faster, cheaper transfers compared to some traditional systems.
Especially for international payments, potentially.
Okay, so Bitcoin really set this template, but then came the altcoins.
Yeah, thousands of them. Alternatives to Bitcoin, often tweaking the original recipe or aiming for totally different goals.
Like what kind of goals?
Some aim to be faster, process more transactions per second. Others wanted to enable more complex applications like smart contracts, things beyond just being digital money.
And naturally, some of these newer coins generated a lot of buzz. The potential for higher returns, maybe.
Absolutely, that's a big part of the allure. If you get in early on the next Bitcoin, the potential gains could be huge.
But there's always a but, isn't there? That potential usually comes packaged with higher risk.
Exactly. And that's a crucial point from our risk analysis source. Choosing between Bitcoin and altcoins often boils down to your appetite for risk versus potential reward.
How so? What makes altcoins generally riskier?
Well, think about Bitcoin's track record. It's been operating since 2009. It's survived numerous challenges, built a huge global network of users, miners, developers, exchanges. That's a powerful network effect.
It's established, battle-tested in a way.
Right. Many altcoins, on the other hand, are much newer. Their technology might be less proven, their security might have unknown vulnerabilities, their development teams might be smaller or less experienced, their communities less robust.
So more unknowns, more things that could potentially go wrong, lower liquidity sometimes too.
Often, yes, making them more volatile and potentially harder to buy or sell without affecting the price. So higher potential upside, but also a higher chance of failure or significant loss.
Okay, that risk picture is clear, but now let's add another layer, regulation, because that's changing fast.
Oh, absolutely. That PwC Global Crypto Regulation Report really highlights this. Governments and regulators worldwide are no longer just watching from the sidelines, they're actively stepping in.
What's driving that?
It's a mix of things. They see the potential for innovation, sure, but they're also worried about protecting consumers and investors, maintaining financial stability, and cracking down on illicit uses like money laundering and terrorist financing.
Makes sense. It's a balancing act.
It really is. And you're seeing major international bodies getting involved. The Financial Stability Board, the FSB, they've put out a global framework and roadmap.
Yeah.
The Basel Committee, which sets standards for banks, has finalized rules on how banks should treat their crypto exposures. They're due for implementation in early 2026.
So banks are getting clear rules too.
Yes. And the Financial Action Task Force, FATF, they're pushing hard on the anti-money laundering and counter-terrorist financing side, the AML-CFT stuff.
Like the travel rule.
Exactly. Requiring crypto firms or virtual asset service providers, VASPs as they call them, to collect and share information about transaction senders and receivers, though FATF notes that global implementation of this is still pretty patchy.
And IOSCO, the securities regulators.
They've issued policy recommendations too, covering crypto markets and even decentralized finance or DeFi, so a definite global push for coordination.
Okay, let's look regionally. The EU seems quite far ahead with MiCAR.
Yes, MiCAR markets in crypto assets regulation is a big deal. It entered into force last year, aiming for full operation by the end of 2024. It's trying to create a single, harmonized rulebook across all EU member states.
For who? What does it cover?
It covers issuers of crypto assets and the service providers, the CSPs. It sets licensing requirements, rules for white papers detailing projects, consumer protection measures, rules against market abuse.
It's pretty comprehensive.
Very. It also links up with DORA, the Digital Operational Resilience Act, which covers IT security and operational risks for financial entities, including these CASPs. And strong AML requirements are built in, with the new EU Anti-Money Laundering Authority, AMLA, set to play a supervisory role eventually.
Does MiCAR treat all crypto the same?
No, it makes distinctions. It doesn't cover assets that already qualify as traditional financial instruments under existing EU law, but it has specific, quite strict rules for stablecoins, what it calls asset reference tokens, or RTs, and e-money tokens, EMTs.
Like requirements for reserves and governance.
Exactly. And interestingly, it actually prohibits paying interest on e-money tokens.
Huh. And who enforces all this?
It'll primarily be the national competent authorities, the NCAs, in each member state. They'll have powers to grant licenses, suspend activities, impose fines, and so on. There's a transitional period until mid-2026, but some national variations might create a bit of uncertainty in the meantime.
Okay, so the EU is moving decisive. What about the U.S.?
The U.S. is, well, it's progressing, but maybe more fragmented. There's ongoing debate about which agency regulates what, primarily the CFTC versus the SEC. Bills like the Market Structure Act and FIT 21 are trying to provide clarity there.
Still figuring out the lines?
Kind of, yeah.
Yeah.
But there's definitely a strong focus on AML and preventing financial crime involving crypto. We've seen a noticeable uptick in enforcement actions in 2024.
Any specific developments to watch?
There's speculation about potential approval for staked crypto ETFs, maybe
Right.
in 2025, especially if the regulatory environment becomes, shall we say, more crypto-friendly, and some more forward-looking discussions about things like a national strategic reserve of crypto or even a sovereign wealth fund investing in it.
Interesting. Now, across the Atlantic in the UK.
The UK is also building out a quite detailed framework. The goal is explicitly to bring crypto asset activities within the existing financial services regulatory perimeter.
Making it part of the established system.
Right. The Financial Conduct Authority, the FCA, has a roadmap aiming for consultations next year and full implementation in 2026. The Financial Services and Markets Act 2023 gave the government the necessary powers.
What kind of specifics are they looking at?
Things like specific rules for stablecoins, which they're calling digital settlement assets. There's work on a digital pound, a retail CBDC, with a decision on whether to build one expected around 2025, potentially launching by 2030.
So a UK CBDC is looking likely.
Seems that way. They're also implementing the FATF travel rule for crypto transfers, developing a market abuse regime similar to traditional markets, and, this is interesting, classifying certain crypto assets as restricted mass market investments,
Meaning?
meaning stricter rules on how they can be advertised and sold to regular retail investors, basically adding friction to protect consumers from high-risk products. They're also looking at legal definitions, like whether crypto counts as personal property.
Lots happening there, too. What about Asia? Any key hubs?
Definitely. Hong Kong SAR is actively positioning itself as a global virtual asset hub, implementing comprehensive regulations. The SFC there has this ASPIE framework guiding their efforts.
And Singapore.
Singapore has been quite proactive, too, regulating digital payment tokens under their Payment Services Act. They're also developing specific rules for stablecoins and actively exploring CBDCs, both wholesale and retail, with projects like Project Orchid.
Australia.
Australia is also developing its framework, following a principle of same activity, same risk, same regulation. They've also made relevant amendments to their AML laws.
It really seems like almost everywhere is grappling with this. You mentioned a whole list of other places in the report.
Yeah, the list is long. Bahrain, Brazil focusing on AML and its CBDC DREX, Canada, the Cayman Islands, which already have VASP regulations, Germany, Gibraltar, India requiring VASP registration, Japan amending laws for stablecoins, Kenya proposing rules, Liechtenstein with its Blockchain Act, Mauritius, Qatar, Saudi Arabia exploring CBDCs, South Africa defining crypto as a financial product, Switzerland, Taiwan, Turkey, the UAE with specific zones like Dubai's VARA and Abu Dhabi's ADGM.
Wow. Okay. So the key takeaway on regulation is?
It's happening globally, it's accelerating, and while the approaches vary, the core goals are pretty consistent. AML-CFT, investor protection, and maintaining financial stability. These rules will significantly shape the crypto landscape.
Right. So bringing this all together as we wrap up, Bitcoin versus altcoins.
Yeah, it's clear they occupy different spaces. Bitcoin, the pioneer, longer history, proven security model, large network effect, may be seen as relatively lower risk within the crypto sphere itself.
And altcoins. A massive variety, offering different features, potentially faster innovation, maybe higher reward potential.
But generally carrying higher volatility, technological risk, and regulatory uncertainty, especially for the newer or more niche projects.
And layered over all of that is this tidal wave of regulation that's still taking shape.
Exactly. And understanding both the fundamental tech differences and this evolving regulatory environment is just crucial for anyone involved.
So for you listening, whether you're already invested, thinking about it, or just trying to understand this major technological shift, keeping these distinctions and the regulatory direction in mind is absolutely key.
It helps you cut through the noise and make more informed assessments.
And it leaves us with a really interesting question to chew on, doesn't it? As these regulations solidify across the globe, how is that actually going to influence innovation? Will it favor the established players like Bitcoin? Or will it create clearer pathways for certain types of altcoins?
Yeah, and will that initial risk-reward profile we talked about, Bitcoin versus altcoins, fundamentally shift as the rules become clearer and more globally consistent?
Definitely something to keep watching. This space is anything but static.